Hello, I'm Stephen Hode, trader, technical analyst and founder of The Stop Hunter. Now, to be a good trader, you're going to need to have an edge. You're going to need consistency, discipline, a plan. You've got to reduce that human bias and interference and psychology in your trading that can be very detrimental to your results. Basically, your emotions can and will have a significant impact on your trading results. And there's one chart type that is absolutely fabulous for negating a lot of those negative points in your trading, and also very powerful at coming up with effective, consistent strategies. Now, that chart type is called Hikinashi, and whether you are a scalper, a long-term trader, swing trader, whatever type of time frame you're involved in, the Hikinashi chart is massively effective in your trading, and it's going to help you be more systematic, more disciplined, stay in those trends longer, which you might found yourself getting those itchy twitchy fingers and coming out at the wrong time and seeing the price go skyrocketing up in the direction you wanted it to be, all to your frustration. And this chart type is going to allow you to create those more consistent strategies. It is really a good all-round effective tool, very good also for trade and risk management. And in this course, it's about 2 hours or so long. I'm going to go through the fundamentals of Hikinashi and give you that head start using this chart type that you are going to need. So let's quickly look at a couple of examples to give you an idea of how Hikinashi simplifies things and makes those candlestick charts more effective. So here we have NIO, the electric vehicle maker, on a daily time frame, candlestick chart on the left, Hikinashi on the right. And what do you notice? Well, the big takeaway here is just look on the right hand side how much smoother and clearer the trends and the movement of price are. They're not going from red green so often. They're consistent, and in that case easier to translate. So then our second example, Amazon, in the 1 hour time frame, just showing you on any time frame it works. Same candlestick set up on the left, Hikinashi on the right. What do you notice again? Again, it's the smoother trends, those jumpy red greens, those gaps, they've all disappeared, and now we've got nice consistent trends and price behavior to follow and work our strategies around. It really does take out the psychology from trading. Now, the course is for all abilities. It's a little over 2 hours long, but it's broken down into small, manageable sub-video chunks that you can break away from any time and revisit. So it's lifestyle friendly. And what do I want in return from you for this course? Well, all I'm asking for is that you like and subscribe to the channel, because it allows me to continue providing you guys with this sort of course and content. So with all of that, let's get on and dig into the course on Hikinashi. So the course is going to be made up of 4 sections, 19 lectures and just over 2 hours of video content. Now, in the first section, it's all about why Hikinashi. We're going to do a bit of course housekeeping first, but then what is Hikinashi, the difference between normal candlestick charts, how it's going to help your trading psychology, and the maths behind the charts. And then we're going to go on to using Hikinashi in trading. What markets does it work well in? What time frame should you use? Types of strategies, and adding on other technical analysis tools to make the Hikinashi chart more effective, such things as moving averages, trends, bands, DMIs, Darvas box, pivots, and so on. And then we're going to see how we can put all those indicators together onto that chart. And then in the third section, we are going to take a quick look at some strategy ideas and trading setups using the Hikinashi chart. And then to wrap it all up in section 4, we're going to do a course roundup. Right then, some housekeeping to get us going, and you're going to see a lot of symbols popping out through the different sections of the course. Please pay close attention when you see them. They're there for a reason. They're going to help you. The first one is the warning symbol, the triangle there. That really could be detrimental to your trading, so really dig deep when you see this. Make sure you understand what you see. Secondly, concept check, the magnifying glass. That's about the theory of what you're studying. The megaphone is important facts that you need to digest before you move on. The exercise book are practical examples for you to get involved with, so we can bring your learning and understanding up to speed. And finally, the tip light bulb symbol. That's from my experiences of trading, which I'm hoping when you see them and learn from them that they give you that extra edge when you come to apply this sort of stuff. So that's that, and well, let's get on with the course. Now, I'm no expert in the Japanese language, but from what I know, hiking translates as average, and ashi actually means foot, speed, gait. So we've got average speed, but for our purposes and for the use in technical analysis, it translates as average bar. So what exactly is it? Well, if you're used to or familiar with the candlestick charts, really it's only just a modified version of a typical candlestick chart. It's a simplified approach that just really takes the data, smooths it out and makes the trends more obvious, and because of that it keeps you in your trades longer and hopefully for the better. So let's summarize those points there. The Hikinashi candle is really just a clearer visualization of a trend, and it's a derivative of the candlestick chart. It makes your trading more systematic and disciplined. It's easier to spot reversals in the change in a trend. And first of all, let's take a look at a basic example of a Hikinashi chart. So here is the one-day Hikinashi chart of the Standard & Poor's 500 stock index in the US. It goes back to March, the chart, so we've got a good period of time. But what I want you to take away from this chart to start with is just how clean the data looks in comparison to a standard candlestick or bar chart. We'll have a look at that comparison in a minute, but the takeaway is just notice how the trends, green bars are up days, reds are down. Notice how this calculation of the Hikinashi chart makes it a much more simplified piece of analysis for you to draw conclusions of whether the market is either bullish, bearish, or when it's going to turn either way. I'm hoping you're now starting to see how Hikinashi is actually a very strong psychological trading tool and useful for those that have inconsistent results, fiddle around with their trades too much, tinker. It smooths things out, it makes things more obvious, which then takes away some of that emotion and creates more discipline for the trader. So we briefly touched on in the last section, there's a difference between normal candlestick and bar chart. So we're going to take our S&P 500 example again and do that comparison now. So on the left of the chart we have the S&P 500 as a candlestick chart, and on the right we have it as its Hikinashi equivalent. It's the same period of time, and what we're going to look at first is the candlestick chart on the left. Notice how the bars go between green, red. Even though the trend is looking quite bullish up, it still could be quite tricky to trade some of those days because you don't know if it's going to go up any higher. Has it reached its peak? Is it going to return, reverse? You just don't know, and it can be quite tricky to trade, and you might get out too early, and like you might get out sometime in July and actually see it afterwards run up higher and higher to record highs 3,600 by September and be very frustrated about your decision to get out the trade. Whereas if we then flip to the right hand side where we see the Hikinashi chart, those green red days have disappeared mostly and are now either all greens or all reds. And this is the trick of the Hikinashi. It's going to make you stay in that trade longer, and hopefully now you can see the visual difference between the two and how more effective the Hikinashi chart could be over a candlestick chart. Just a bit about the colour of the bars. I have them on my chart as green for up and red for down, but there are no rules on what colours you can use in any charting package these days. You can change it to whatever you like, as long as you can remember what's up and what's down. Do whatever you want colour wise. Now, the other really good thing about the Hikinashi chart over the ordinary candlestick chart is that you don't have to learn hundreds of those bizarre sounding patterns that can make using candlestick charts in the proper traditional way very tricky and very difficult. And again, that adds in psychological elements of doubt and mistrust in what you're looking at. Fortunately, Hikinashi, it narrows it down to just a few simple patterns that are so easy to learn and recognise that, again, it helps you immensely become more disciplined, more structured, systematic type of trader. Now, I took this image from a tweet on Twitter that I found just to give you an idea of the sort of patterns and their strange names that are available just on standard candlestick charts if you're not familiar with them. And this really is just the tip of the iceberg. You can have patterns from 3 bars up to 7 or more in some instances. There is really a big library of these type of patterns that are very difficult to memorize. So let's take a look at what you actually only need to know using Hikinashi charts. So far we've drawn some sort of conclusion that the Hikinashi chart makes things a lot more smooth and easier to spot the trend, which is excellent for our trend trader friends, but it also, narrows down the type of candlestick patterns that we need to look at, and there are just 2 that are of interest to us. One's called the doji and the other the spinning top, as you can see on that little picture that I've got there. And why are these important? It's because they are highlighting places on the chart in that time frame that are showing as indecisive or potentially reversing and turning on the previous trend. So the doji and spinning top is a good red flag to us to look out for. So let's take a look at an example of some of these dojis and spinning top patterns in action. So here's a 5-minute chart of WTI crude oil, and I'm just using this one to illustrate various obvious turning points in those type of candle patterns that I'm trying to illustrate to you here. And we got various examples through this brief period of time on crude oil, and you can see how obvious when you start to look at them they are for your analysis. What you do have to remember though, and which is quite important, is that this isn't an exact science. So those patterns that were on the previous slide are the obvious examples, but they don't have to be 100% as accurate as that. They might have the main body of the candle a bit higher, a bit lower, a bit fatter, a bit wider. So you do have to bear that in mind. So just using these on their own I don't think is 100% reliable, but it is a very useful guide, and as we go through the course we'll learn how we put other indicators and tools on top of these charts to make this analysis more accurate. A quick point on the colours of the dojis or spinning tops. From my experience, well, my rule is it doesn't really matter whether it's red or green for the reversal candle to hold. So you might be in a bullish uptrend and get a green doji or spinning top, and then the next bar down's a red. It wouldn't matter if it's either a red one and the next one's down a red. So what I'm saying here is the loose rule is do not worry about the colour when you see this type of candlestick pattern, because from my analysis it doesn't make much difference to the change in the results. What we're seeing here is a manifestation of that type of pattern, and we need to bear in mind what it's trying to tell us over rather than over the colour that it's showing. So before we move on, I want to just remind you about the doji and spinning tops and their usefulness within the charts. They are very good. They do highlight very easily indecision points, possible reversal points in the trend and the price of whatever we're looking at in any given market, but they are not, and I repeat, are not 100% reliable and require further supporting evidence and tools and indicators that we're going to look at over the next few sections to build up a successful trading strategy. I think it's starting to become obvious why Hikinashi charts can help your trading psychology, but we're just going to look into it now in a bit more depth. So what are some of the advantages of Hikinashi charting? Well, as we've seen, it takes out a lot of the psychology and noise around the charts, making decision making a lot more easy. And as I've seen in my time, that traders often cut their trades, come out of them far too early and regret their actions. Hikinashi puts the brakes on this and hopefully keeps you in longer to more profitable trades. And this action of coming out too early and not letting your profits run, I've seen mostly in inexperienced traders. So if you're new to trading, then this is a really good chart type to sort of get your teeth into this world, to make yourself more consistent and a more disciplined type of trader. On the flip side, I've also seen traders trying to force their way to a successful trade and therefore breaking their trading rules and their original mental trading model strategy. And again, this is where Hikinashi can help, because if this is your strategy and it's built off of Hikinashi, then it's going to make you stay in those trades longer or get out at the right time, rather than you trying to manipulate something that you shouldn't be and going against your original idea. So another major psychological problem is that when we start to win and we become more risk averse, we want to hold on to our money, and when we start to lose, we become bigger risk takers. We let the trade run and we make stupid decisions, and this is where Hikinashi again can help you. Why? Because you're going to let those winners run longer and you're going to cut those losers shorter, because you are following a systematic approach that Hikinashi is giving you. You follow the rules more simply than if you were say using a candlestick chart or a bar chart, because it's more obvious to the human psyche and therefore we make better trading decisions. We are all guilty of it, me as well, and people do struggle to deal with the psychological movement of price. It makes you do silly things you didn't want to do. You panic, you stress. Are you going to make money? Are you going to lose money? Are you going to lose it too quickly? We get too absorbed in the now. And this is why Hikinashi just eases you out of that pain and slows things down and makes you think more carefully and more considered about your trading. Let's take a quick look at another example. Now, the US dollar Mexico peso currency pair is a notoriously difficult one to trade, and I've sped it up further into a 1 hour chart. On the left we have our candlestick chart, on the right our Hikinashi chart, and again, just really for illustrative purposes, just showing you that on the left you can see the reds and greens, the different ups and downs, the trends within the trends that make it really difficult to make a decision. But on the right hand side, everything looks a lot calmer, smoother and clearer around being able to make a more objective trading decision. Let's dig in now to a bit of the science and maths behind the Hikinashi chart. This is essential and you need to understand it because any successful trader needs to know how their tools work, and if you know how they work you can apply them more efficiently. When I said science and maths, don't worry, don't panic, it's not that complicated, it really is quite simple. All you have to do is think of it as two candlestick charts merging into one superior Hikinashi chart candle. As you've guessed by now, it is a combination of two standard candlestick bars merged into one Hikinashi bar, and the output is extremely similar to the traditional candlestick, and what you're trying to produce, like the traditional candlestick, is the open, high, low and close price. So for each Hikinashi bar there is 4 parts or components we need to calculate, and as we can see here, X is the current period and X minus 1 is the prior period. So first of all we need to calculate the close. How do we do this? It's quite simple. The close is the open of the current period plus the high of the current period plus the low of the current period plus the close of the current period divided by 4. So for the Hikinashi open, it's just the average of the prior Hikinashi candlestick open plus the close of the prior Hikinashi candlestick, and there's the formula you can see there. And then the high is the maximum of the current period high, and the current Hikinashi candlestick open, or the current Hikinashi candlestick close, and once again there is the formula. And finally, the fourth piece of the jigsaw, the low, is just the minimum of the current period low, the current Hikinashi candlestick open, or the current Hikinashi candlestick close, and again there is the formula if you'd like to calculate it. So as you can see, there's really not too much to it, just the 4 parts you need to calculate, and then you have your Hikinashi bar. But what about calculating the first price in the chart? So I've got an example here of 2 candlestick Hikinashi bars of data on the S&P 500. X and X minus 1 is the data, and therefore the current Hikinashi bar open, high, low, close of those 2 bars would be giving us an open price of 2049, a high of 2064 and a low of 2049 with a close of 2057. So really all pretty simple and straightforward so far. So there's 4 other important things we need to learn and take away from this. Is firstly that traditional technical analysis patterns like triangles, heads and shoulders all still work on Hikinashi charts. You'll also notice that on Hikinashi charts there aren't any gaps like you would get in a bar chart or a candlestick chart. And also, and this signifies key selling or buying pressures. On a Hikinashi chart on big down bars, there's little or no upper shadow, signifying a strong trend, and vice versa on big up bars with little or no shadow, highlight strong buying pressure. And again, the flip of this is if you have big candlestick wicks, shadows, then this signifies weak buying or selling pressure. All these 4 points are very important, but none more so than the significance of the shadow or wick on the Hikinashi candlestick, as this obviously signifies strength and weakness. So we're going to take a look at those 4 points a bit more closely through an example. So here we have an example of the euro against the Turkish lira on a daily Hikinashi chart. It's an obvious uptrend, but it's a good example of highlighting the 4 points that we've just looked at. So the first point was that you can still use technical analysis, traditional classical patterns like triangles, heads and shoulders, trend lines, and we'll just quickly draw on some of those now just to illustrate that. Now, these patterns are crudely drawn on, but you can see wedges and triangles at play in this uptrend, just to illustrate the point that, you know, the old stuff still works on these Hikinashi charts. So the second point, notice that there are no gaps between each individual bar. They flow seamlessly, fluidly between each other. And this also takes away the psychology of gaps and what happens next, and also makes it a much clearer picture because it draws in, fills in those gaps and makes the trends more obvious. So point 3, up bar shadow wicks. What does that mean? As the trend gets stronger, you'll notice that there are no wicks underneath a green up bar, but you get a bigger wick above the candle. And as the trend weakens, you'll start to see the wick of the candle start to grow beneath the up bar. So this is quite significant to highlight as it points out strengths and weaknesses in the trend. Really, point 4, down bar shadows wicks, is just the opposite of our third point about the up ones. So let's focus in on a recent down move in the Euro TRY to illustrate this point. So you can clearly see as the downtrend strengthens that there are no wicks above the main body of the bar, but as that downtrend weakens, then we start to see wicks appearing above the main body of the down bar. We can clearly see now how supply and demand are fighting one another, the bulls and the bears at war with each other, but we've got a lot of clues and a lot of nicely presented clues to give us a better idea of where the price of any market or in any time frame we're looking at is going to go. I get asked very often what markets does Hikinashi work well in, and there's one simple answer I give people every time, and it's actually all markets. So assuming that Hikinashi does work across all markets, there's some further considerations we need to take on board. The first of these is volatility, and I will go into this more later in latter sections of the course, but for now what you need to know is the more or less volatile a market at its extremes, then the more you're going to tinker and try to undo Hikinashi's hard work. And what do I mean by that? I mean, if you know that there's been a big move on the instrument you're looking at, but your Hikinashi bar isn't showing that yet, you will get itchy fingers and try and switch back to maybe a candlestick or bar chart to try and see what's going on, and then trade around that information rather than what you've seen on your Hikinashi chart. We also have to be aware of gaps in our charts, and remember we said that there aren't gaps in Renko charts because obviously they fill in that movement. But remember, in equities and commodities, these markets exhibit, often quite large gap movements, and that's actually important analysis. And because of the fill-in approach of Hikinashi, it's going to often mislead the user into missing these situations and understanding what that's telling you as, a potential price action movement. So just bear in mind when you see big movements or hear of big movements, just check out what's going on. And finally, don't forget costs of trading, the broker spreads, the markets you might want to use for your Hikinashi strategy. It might just not prove to be cost effective, so please look into how much it's going to cost you to trade your particular approach and whether actually in the long run it's worth it. So now let's have a quick look at a few examples to give you a better idea of how Hikinashi can be applied across markets. So to start with, we have a lean hogs chart, and for those that don't know, that is American pigs. It's a futures contract, and it's quite illiquid compared to most, and very volatile and tricky to trade. And on the right hand side of this screenshot we have the traditional candlestick chart, and you can see a lot of gaps which we've talked about, and we can also see big bars and small bars, so a tricky one to trade. Then again, if we flip over to the left hand side, we see the Hikinashi chart, and on this daily view you can see how that smooths out those jumps, and although a risky asset to trade, it would make it a lot easier psychologically to perform in. So our next market is Tesla, a very popular US stock at the moment for obvious reasons. Again, on the right we have a candlestick chart, on the left a Hikinashi. This is a weekly view, so a really long-term view going back many years, but you can, although it's been in an obvious uptrend, you can actually see straight away the strength of that uptrend by using the Hikinashi chart on the left. And here we have the DAX, the German stock market, one of the most popular day traded markets out there, especially in the retail trading environment. This is a 4-hour chart. On the right, the candlestick. On the left, the Hikinashi chart. A couple of months worth of data. Again, see how the Hikinashi smooths out those moves and gaps within the market. And to finish off this section, we've got the Euro USD, another extremely popular traded market by retail traders and professional traders. It's one of the biggest currency pair out there at the moment. And on the right, the candlestick. On the left, the Hikinashi. This is just 5 minutes, so it's really fast. It's only a few hours of data there. But again, just notice how there's more consistency in the trend approach, and also a visualization of trends turning in the shorter term. So again, you can see in all those markets the benefit of using Hikinashi. So the next question I get asked a lot is, what time frames should I use to trade Hikinashi charts in? There's many considerations we need to take on board here, and we're going to have a look into that now. A bit like in the last section where there was a one-word answer, well, the answer here is any, really. It really does work very effectively in any time frame that you want to get involved with, and we're going to have a more in-depth look now across some of these time frames and how you should use Hikinashi in them. So to start with, where do you focus in on? Well, it depends really on what your trading strategy and approach is, how much time you've got in front of your computer screens, what you're trying to achieve, but some general guidance for you here. Scalping, day trading strategies, very good between 1 and 15 minutes. Swing trading, 1 hour plus. Trend or reversal trading, 2 hours plus. But there's some more generic rules that we need to consider before moving on. The first of these is building multiple layers of time frame analysis. We're looking to look above our trading window, whatever time frame that is, to try and ascertain the momentum, the force, the flow of the market above that in the higher time frames, because that often gives our time frame that we're trading in that push that we need. So if we can align that, that can give us a much stronger trading strategy and trading approach. So there are some basic rules that I've laid out to determining what higher time frames you need, and I'll put that together into a chart. So here's a little helper for you. If you're new to trading, then this table is good for any technical analysis that you might want to do, especially in your trading. But to give you a brief overview of the table, we're presuming that the blue column is your trading time frame window. So if we were, for example, using a 5-minute trading time frame, then we would look at the 30-minute for our next higher level of analysis, and then above that the 240 minutes. So depending on how far back you want to go, which borders on the realms of sensibility, that's the windows that you should be looking at. You trade in the 5-minute, you go up to the 30-minute and the 4-hour, 240-minute to do your analysis to gauge the flow. So if we then drop down, say we were trading 240-minute windows, either 4 hours, we would then look at the daily and the weekly for our analysis. And you're asking if I was quicker than 5 minutes. Well, just go up to the top there and look at the 1-minute window. If that's your trading time frame, then use the 5 and the 30 as your analysis. It's quite simple, but if you can get that sort of ingrained into your trading, then that's a very useful, effective way of working out the flow of the market, like I said, to give you that extra boost to your trading window. It's not the greatest example, but we've got a multiple time frame analysis here of the euro against the Great British Pound. And if we assume that our top left chart, the 5-minute one, is our trading window, then the one to the right of that is the 30-minute, then the one in the bottom left 4 hours, and then in the bottom right 1 day. If we actually work our way down from the top time frame, we can see the 1 day is moving downwards. We can see that the 4 hours is moving downwards and the 30-minute is moving downwards. We would then be looking for down signals, down trades in the 5-minute window. So if we were scalping or looking for trend reversals, then we would put more weight to the down move in our trading. But this price analysis just on its own, I would say, is very risky, very dangerous. We need more confirmation. But this was just an example to show you how the time frames evolve with Hikinashi and how you can put those higher time frames to use versus your trading window. We've covered markets, we've had a look at time frames, so now let's have a look at putting more meat on potential trading strategies and the types of strategies that we could potentially use and how we can build technical analysis into our trading. Let's take a look at a real basic example of a trading strategy approach. This chart is an old one, but it doesn't really matter when it was from, but it's going to highlight some of the 6 possible basic trading strategy approaches you could use on the raw Hikinashi candles. Now this is the Euro USD in a 15-minute chart, so it's a quite quick time frame. But again, it doesn't matter on the time frame. These 6 approaches work across time frames, but it's to give you an idea now of what you could potentially be using. So here's our Euro USD 15-minute chart. The only other indicators I've put on top here are the stochastic, and you'll see some lines under the price. They are pivot points, and we'll look at pivot points later. But we can now see those 6 different approaches using some really simple analysis to create entries and exits into any potential trade. We can see general reversals using our doji spinning tops that we now know about in terms of patterns, and we all can also see reversals off of pivot points, key lines, and we can see bounces off moving averages, for example, and we can see how the market pauses and continues after a trend, and we can also see by just applying trend line analysis, so breakouts of the price, to signify a new entry point to any potential trade. So overall, quite simple, quite quick analysis, but still that's based more off of the price rather than supporting indicators. We did use the trend line and the pivots there. We didn't even touch the stochastics. So we're now going to move on to building up this analysis to make it a much stronger approach to your trading and put the odds more on our side. We're now hopefully starting to build a picture that Hikinashi is actually a good all-rounder type chart, one that we can use across multiple types of trading approach, and we're just going to have a quick look at some of those type of approaches now. And for those that are new to trading, I'm just going to elaborate a bit further on what those types of approaches are. So our first strategy is swing trading. It's a short to medium term approach. I like it quite a lot, especially using the Hikinashi, and I think it's very good for newer traders as well to take a look at. Then we've got our trend trading. This one, I'm trying to get the momentum of the market from any time period, actually short to long, and in either direction, long or short. Then we've got scalping, which is really the fast-paced, computer clicking, button shooting type approach. You're talking one minute or even less, to 15 minutes maybe, using the Hikinashi. Short-term movements in the price that you're trying to capture, very tricky, and you've got to be very consistent with this approach. And finally, trend reversals. We're trying to capture the change of direction in the price of any market that we're trying to analyze. So all these types of strategy approach use technical analysis to do the execution and trade management. So we need some basic pre-strategy technical analysis rules that we need to build in and adhere to in our trading. So the first of these technical analysis rules is the rule of collinearity. It's very important. You must understand it because it's going to save you a lot of pain in the long term, and it basically is to avoid the multi-collinearity amid indicators, and that means stop multiple counting the same type of information. So for example, we have the RSI, MACD and rate of change, they're all based on the closing price. So why use them? Because you've got 3 different tools all based off the same information, probably giving you the same answers. What we're looking for is maybe 3 indicators coming from 3 different angles to give us the same answer, and that therefore means a stronger chance of our trade winning. So I have just put down a few combinations of possible ones you could use. For example, the ADX, an oscillator, a moving average, MACD and stochastic, the RSI and stochastic, parabolic and DMI. So we're now going to go and try and work out what we should actually be using in terms of indicators. Another one of those questions I get asked a lot is, what indicators work best? What ones should I use? Well, and I will always respond with, there is no right answer to this. It depends on many things: your trading style, strategy, objectives, timeframes, markets you're trying to use. But what I try to do is that especially if I'm trading across markets, is try to make it as generic as possible and that they work generically. There's thousands of indicators out there. You could spend a lifetime going through them, and I use the ones that work best for me, and it's really been a case of trial and error and back testing and learning from them. But here I'm going to try and give you a starting point to get you going, and this is in the form of a table that you can again take with you, a bit like the time frame table, as a useful tool in your learning. So before moving on to that table that I mentioned, bearing in mind the rule of collinearity and the basics of technical analysis, we're looking for supporting evidence to our Hikinashi charts from multiple independent sources that are going to help confirm what we can see going on with the Hikinashi bars. And then if we've got that information, we are trying then to use that to put the odds and the probability more on our side. So what does my table look like? It's quite a simplistic approach. We've got 5 columns: trend, momentum, volume, volatility and sentiment. And what I try to do when I'm putting a combination of indicators together is take one to start with from each, or from 3 of them or 2 of them, just to give me that independence. So for example, in the trend I might take the MACD, and in momentum I might use that in combination with stochastics. It's that sort of idea to get you started in your trading. And like I said, it's very much trial and error, and you're going to find ones in this table that you hate, ones that you very much like. Try them out, see what works, get stuck into them, play around, and then build a strategy around it. Like I said, there's thousands of potential technical analysis tools you can use, but I'm just going to use a handful here. We're going to use the awesome oscillator, the directional movement indicator, moving averages, trend lines, RSI, bands, the Darvas box and pivots. And the next part of this course will go over those individual indicators, not too in-depth. There's also run other courses if you want to get into them, but to give those less familiar with them some sort of context, meaning behind them when I'm using them going forward. So if you are familiar with those types of indicator, you can skip this section, but it wouldn't hurt to revisit them. You might get something out of how I look at them and use them, so up to you. But definitely for newer traders unfamiliar with them, please go through the next section, because you'll make your understanding of the latter part of the strategies that we look at a whole lot easier. We're now going to look at some of those tools and indicators I said we were going to address. In this instance, it's trends. You may know all this stuff already, but it's no harm going over it. So what's a trend? General direction of a market or of the price of an asset. How do we measure that? Well, it's going to go up, down, and sideways. Sideways being trendless, and it's going to have 3 major time classifications: 6 months to 1 year, 3 weeks to 6 months and less than 3 weeks, maybe better for timing purposes. So here's our chart that shows us through the 3 different periods in action. We've got a longer term blue line, the longer term trend, we've got green lines showing a medium term trend, and then under that we've got our red short term trend. So you can trade all those at the same time. You might just want to trade the short term one. So by determining the direction of the trend, you're going to come up with 3 trading decisions: either to go long, go short, or do absolutely nothing and stay on the sidelines. And remember, importantly, that the market trends roughly only a third of the time, so you need to know when it is happening. That's very important for what tools you're going to use. So here's a quick example on the S&P 500 on a Hikinashi chart, daily chart. Green arrows, short-term trends, red medium, black dotted line there, the longer term trend. It's just showing you how it works on a typical market. And really the rules of trend drawing are important to know. If you have 2 touches on a trend line, that's only a tentative trend. You need 3 or more for confirmation of that trend, and that's very important to know and to apply. And it can be drawn on any charts, even the Japanese Renko charts that we saw earlier. And you've got to draw the trend lines through the lows in an uptrend and through the highs in a downtrend. And it's a very discretionary, a subjective trading drawing process. So here's a gold chart that I actually used in Bloomberg terminal while I was trading away, just giving you a simple example of a trend line that's touched multiple times, where 5 or 6 before it breaks. So the more touches, the stronger the likelihood of that move outwards and away, and as it did in that instance, it went flying high upwards. Here's another one, Diageo PLC, UK company, and again, this is subjective. You might see trend lines in there that I don't, and that's what makes it more subjective, less objective approach, but also very useful to your trading to understand. So what applications can we use the trend line for? Well, we can use it for price objectives, when the trend is changing, the strength of the trend. 45 degrees is a very important number. That's the optimal trend line. We can use channels to bounce prices between, and we can also do it for entering, long short positions and profit loss taking. And we can see here on the Hang Seng a typical channel example of the trend, how the price has moved up and down in a range, popped out briefly and then went back into that range. So it's a very useful tool, trend lines. So here's an exercise for you. This is a typical blank chart. Find one for yourself and then just practice to your heart's content, drawing as many trend lines as you can to work short, medium, long term. So moving average, a great, effective, simple tool to apply onto your charts. Basically, it's, and you might have seen this in other walks of life or in your maths classes of old, it is a smoothing of a time series of data. It's easy to build and test. It's also easy to get in and mess with, and it's a very subjective process, but you've got to use it as a guide to the trend more than as a trading signal. But you could use it, say, for exits, entries, in combination with other tools, but as we said, it's a smoothing of a time series and gives us that insight into what the trend actually is and takes out the noise. And there's different ways of calculating: exponential, linear, weighted. Some people use one, some people use a combination and use crossovers of those to create signals, although that can be dangerous, as I'll explain shortly. And on top of that, there's other popular methods. There's like the triple crossover, 4, 9, 18 period. There's a one based around envelopes of percentage of price move. There's the Donchian bands, are based off of a 4-week look back period. We have our Bollinger bands that use an input of a moving average to help analyze the standard deviation move of the price. We've got moving averages tied to cycles, 5-day, 20-day, that can measure behaviour easily. And you've got indicators on top of the oscillators like MACD that use the moving average. And in certain markets, these rules can't be beaten. And if the price is greater than, say, the Renko blocks, and it's bullish, and vice versa. But there is a problem. They only work when the market is trending, and this is what catches people out time and time again. And we need a tool that can be used to tell us whether it's trending or not. And in my world, I use the DMI. So let's have a look at an example here. We've got Amazon on normal candlestick chart, 1 week. So it's a long period of time there to have a look at, but we've got this set up as a Hikinashi chart to just smooth out the data from a standard candlestick chart, and we can add the moving averages and change them around in this section here. You can see we've got 50, 209, 20, 100 all set up, and we can unhide them, hide them. We've got the short term 9 period here. We can see how that interacts in and out the price. As we move out in time periods, we've got a longer term indicator, and as they cross through the price, we can actually then see whether it's a buy or sell opportunity, or it's trending or it's not trending. So above is the price is up, and vice versa. So we might want a longer term look at the things what's going on Amazon, and we've applied a 250 moving average here, and the price is definitely above both in July, so I'd be more bullish. And then we could maybe use the 9 moving average to time our way in and out of a potential trade. And here's just some examples adding on further moving average time length indicators to mix up. And as you can see, you can create various strategies around this. So these moving averages paint a picture of a trading cycle. And you may have heard of the Turtles. They used a 4-week monthly cycle to create a Donchian strategy, and they made a fortune out of trading that. So some final notes on the moving averages. Pros, really helpful in finding the trend direction. It helps you let profits run and you cut your losses. Good for support and resistance, entries and exit, and really strong for trade management, as we will see. Cons, doesn't always work in non-trending markets that well, and people often optimize it and get in trouble because of that. Now I'll just throw this one in here. The awesome oscillator created by Bill Williams, just an indicator to measure market momentum based off of a closing price and variables, very similar to the MACD. Here's its calculation if you're interested. When we're using it in normal circumstances, we don't really need to know. What's it supposed to do? Well, it's going to tell us really it's going to just give us a buy and a sell signal, and it's normally pictured in a histogram version, but I like to change that to a line view, as we will see. But it is great for creating signals, as you'll see. So here's our gold friend again, and we're going to add on the awesome oscillator. We find it in our drop down. There it is. As you can see, initially it comes in as a histogram view, and I want to change that because I'd find that a little more complicated to translate into buy and sell signals, and you'll see any second what that will look like. Just switch it to a line chart, make it a bit more visible for us. And then what we will do, we'll zoom in a bit to make it even easier to see. And now we've just got green lines for bullish and red lines for bearish. And you can see where the actual signals change. Here we got red to green, and as you can see in the price above, what a great signal that was. And you can see green to red, and it turned bearish, and what a strong signal that was. So here's a tool, let's go through the chart, pick out some other examples. It's really quite a strong tool, simple but strong. The relative strength indicator is another of Wells Wilder's inventions in the world of technical analysis, and his basic thinking behind it was that in an uptrend closes tend to be higher, and in a downtrend closes tend to be lower. And please note that it only uses the closing price in its calculation, but it does smooth out the erratic and sharp changes in price. So it's sort of like a volatility calculator based off closing price, and 14 days is the normal default input. If you want to speed things up, take it lower. If you want to slow things down, move it higher. It is expressed as a number between 0 and 100, so anything over 70 is viewed as overbought, and anything less than 30 as oversold. So what is it useful for? Well, identifying support and resistance levels, giving us overbought and oversold levels, as a strategy system in itself, trend line breaks. But I like to ignore the 70-30 line that we talked about and just create a middle 50 line, and as it goes up through it I call a buy and down below it a sell. So here's gold again, our example from earlier. We add on the RSI from our trading view charts. There it is. We're going to format that quickly because they're not my sort of colours. There we go. We put on the 70 and 30 bands. See how that works. We've got the 70 on the top and 30 on the below, and normally when it breaks above and comes back down, bearish, and vice versa for the bullish side. But it didn't actually happen many times over that period for gold, so I want to giving you a very few signals to trade. So that is why I like to look at just the 50, and I adjust that by going into the settings again. So here it is with the 50 line placed on, and we're going to get a lot more opportunities to buy and sell as it crosses up and down below. I've also added on here a moving average, same principle as the 50 line, but it's just a bit more proactive in finding us trading signals, but used exactly the same way. As the price goes down, it's a sell and vice versa, and we can add on a trend line if we wanted to on top of the RSI, and again same thing as the trend breaks, we might want to buy. The price goes up through the upside, it might be a buy, and vice versa. We can use the RSI as a very strong trading tool, and it works very nicely on the Renko charts, as we will see later. We're going to take a look at band-based indicators, and these are bands around a price range around the original price, either above or below. They overlay the price on the chart. They can be based on percentage, statistical measures, volatility, and they'll move with the flow of the price. And we're going to look more particularly into Bollinger Bands, and these are bands that are placed around a moving average at default 2 standard deviations away. And what does this allow us to see? Well, it allows us to see 95% of the price action, and as a general rule, prices are thought to be overbought when it hits the top of that band and oversold when it touches the downside. Although, as we'll see, that's not necessarily the case in all instances, but they're a great tool for targeting, maybe as a strategy, those band levels. So here's an example with gold again, a Hikinashi chart. So we're now going to add on the Bollinger Bands, and we're also going to add on top of that Bollinger Band width indicator. There we go, both are on there. We've got the upper band, lower band, and what we call a basis line, which is that middle moving average period. That's normally set to 20 as default, and the 2 bands to ±2 standard deviations. And the bandwidth there tells us how fat or thin the bands are actually going, which can give us a pinch point in price action. Normally can explode out after a narrow ranging bandwidth, as we can see in the example there. So you can play around with the inputs into the Bollinger Bands if you want to create a more specific strategy, and we do that by simply going to the settings and the inputs. You might want to up the standard deviations that you're looking at. You might want to expand the length of the moving average, and then all of a sudden you've got a completely different look to your Bollinger Band chart. You've got a pinch point there, but like I said, it's up to you the variables you use, but try not to backfit the inputs. So we can see how the price bounces around in our new range and how the bandwidth expands and contracts as another measure tool. And here's a typical example of, in a longer term, how that pinches and then breaks up to a more bullish move. But we don't actually know from the Bollinger Band which way it's going to go. We just know that it is going to move, and that's why we'd have to use other indicators along with it to confirm the actual move of the price. So to summarise the Bollinger Bands, that they're very good at creating support and resistance levels, and you can use maybe the moving average in the middle as a trailing stop level. They're much better at determining the beginning of a trend and not trading between them, and when the bands tighten, that can often signify an explosion in the movement of the price, although we don't know which direction. And a little tip there then, if you adjust the moving average, then it's a good idea to adjust the standard deviations. For example, a 50 moving average, you might want to make the standard deviations a bit bigger, 2.5. A 10 moving average, take it down to 1.5 standard deviations. Remember that I said that moving averages don't work all the time. We need to know when a market is trending or ranging. Now this is what we're going to look at now. And remember that markets trend only 1/3 of the time. That means there's 2/3 of the time when they're not. And we need a tool that allows us to filter whether it is or isn't. And then on top of that, certain indicators work better in certain time frames. So you can do this very many sort of different ways, and you can look just by an eyeball test, mathematically, some rule-based approach around moving averages, and there's even indicators like parabolic SAR that I've used, but the best one in my opinion to use is the directional moving indicator, and it's developed by J. Wells Wilder in the 70s, and he just wanted to work out some more mathematical, systematic way of being able to measure such a thing. And it's made up of 3 parts: the plus DI, which is the upward trend movement, the minus DI, the downward, and the average directional movement, which gives you the trend range. And it's normally set to 14 periods. And the basic rules behind it: when the DI crosses, the plus DI crosses the minus DI, it's put long position to be taken, and vice versa, minus through the plus DI, and greater than 25 ADX, it's trending unless it's ranging. And if you're long, the reverse point is the low made on the day of crossing. If you're short, the reverse point is the high made on the day of the crossing, and the ADX is greater than minus DI or plus DI, indicating a turning point, and when ADX is less than both DI lines, stop trading, get out. I want to show you on gold though what that looks like, and then how I develop the DMI further to be more effective for trading in Renko. So we've got a Hikinashi chart, 1 day gold. We're going to search our trading view charts for the directional movement indicator. We've put it on. We see our pink line there, which is set to 14. That's the ADX line. We're just going to make it a bit more visible for you. There we go. So we've got our DI plus line, the bullish line, the blue one, the bearish one, the orange line, the DI minus, and our ADX trend filter. There you can see at the moment it's pretty high, around above 40, meaning we're in a strong trending market. But we can also see that the crossing at the moment, the two lines, which could signify a trend change, and here we have an example of such a happening when it started to turn more bullish. I like to use it without the ADX though, as a simple crossover tool. So when the blue's above the orange, it's bullish, and when the orange is above the blue, it's bearish. And you can see what happens when they cross. They then create a more powerful trend change indicator. So what exactly is the Darvas box? Well, it's a great story really, because it was an idea that came about from a guy called Nicholas Darvas, who actually was a ballroom dancer turned trader. So it just shows you that, you know, the retail world can also have great ideas and successes. But it's a theory from the 1950s, and it's based around the idea of breakouts around highs and lows that brings in a trend following approach. And it's got the box name because, as you'll see shortly, it's about the price moving outside of the box. And this guy, Nicholas Darvas, turned $10,000 to over $2 million in 18 months. That's pretty phenomenal. Back then, I think it was in the 1960s, early 1960s, he did this. And he actually wrote a book, How I Made $2 Million in the Stock Market. And I've never seen the book, so it might be worth someone digging it out and seeing what it has to say. But it was a great idea. But over time, you know, like any idea, it has its critics, and they say it doesn't work in bearish markets. But from my experience, especially if you play around with it a bit, I think their suggestions and analysis is wrong. And it has evolved from the 1950s and 60s. And I guess I've also evolved that concept on, but I really like the Darvas box, and, you know, so much so I might even turn it into a course. So the original rules are quite simple, but remember it was based on his analysis of the US stock market. There's 6 points here of how you can come up with the original rules. I think they're probably, I don't know how relevant they are today. Maybe someone would like to try that approach and backtest it and see if it still worked as its raw state. But so mine's modified version, which we'll see in a minute. But basic rules, you know, he looks for stocks making new 52-week highs, then filters them on stocks that have pulled back with, you know, for 3 consecutive days from those 52-week highs, and the new 52-week high is the top of the box, and the prior breakout to reaching the 52-week high is the low of the box. And after that low is formed, the price should not break that low for at least 3 days, but then when the price breaks out to the upside, you buy it, and vice versa. When it breaks to the downside, you sell it. That's the basics of the rules. Now let's see how that's evolved and how you can put that into your trade in a more modern context. So I suppose I use the Darvas box purely as a breakout tool across all markets and time frames. And you might find it a hard indicator to get your hands on, and it's not available in all chart packages, but it's definitely available in TradingView. So I've got my hands on it and I use it quite a lot. So let's take a look at how I use it and how you could potentially use it in your trading. So here we have our standard S&P 500 index chart, daily chart, Hikinashi, over probably 6-7 months of data. So we're going to apply the Darvas box to it, and we find that in our indicator section. This is TradingView, so it's there. So I'm just going to undo it. So its actual default settings on TradingView come to 5. So the basic principles of our Darvas box here is we're going to get a buy signal as it breaks out, and that's confirmed with that tag there, the buy tag. And as we can see, it breaks out nicely and goes up. We have some semi-weak buy signals. We have some good strong ones, which have a bad sell one there, and a sell which we got in actually trailed down and went back into the box. We could have made some money there, but it wasn't the strongest. So Darvas box very good on its own, but you can see it does have a few issues. So to get round those, I add other indicators. So we could have something like a 50 moving average that then filters out those buy signals. So we only take the buys if it's greater than the moving average, and the sells if it's lower. So we'd have only if it closes through that moving average, by the way. So we might have missed out on that one, but we'd have got that one. Unfortunately we might have missed out on that one, but we would have got into that not great one, but we'd have picked up that one, that one, that one, and that one. So some good trades. So I like to further add more substance to my decision making by adding further indicators. So here I've got the awesome oscillator. So again, in conjunction with this setup here, I'll be looking between flips between red and green. So we've got a buy here. Yes, it was green, good to go. What happened at the red? Yes, we had red, good to go, red, good to go. But as we know, we had these other things up here making us either stay out or go into it. So I need the trend indicator on top of that. I'm just going to put on the DMI, and that was set to 20, and that's going to give us a trend. Green's up, red's down. If green's greater than the red, it's bullish trend, and vice versa. So we have our buy signal here. It's green, we're in. Green, we're in. What about those reds over there? Sell, red, we were actually in that, but we might not have got in because of the 50 moving average. This red one here, yes, we were all in. So you can see by putting together combinations of indicators around a principle, which is the Darvas box, you can make it stronger, more efficient. It's good on its own, but why not try it and experiment with it and see what you can come up with. Again, change those settings. If we move it to a slower Darvas box, what does that give us? Doubling it to 10. Yeah, we got some nice breakouts. Again, line it up with your other indicators on the chart. So something to think about, something you might want to add into your trading. Pivots really are a great tool, and you might have come across them before. If you haven't, they're similar in a sort of way to Fibonacci, and actually you can get Fibonacci pivots, but in the short term, when I say short term, I mean for short term traders in, say, the day trading, low minute approaches, then it's a great weapon. And the Forex traders of this world, and now more so indices and commodities in the more liquid markets, use pivots as a tool to set stop losses, entries, exits. It's very effective, and more so now that the pivot points can be adapted for the longer term, whereas they were initially used as a short-term tool. You can change the settings in your charts to give you a longer term look at support and resistance levels. We have to think of pivots as price magnets. The lines that they create are like heat seekers for price action, and you'll notice, and through some of the examples I'm going to show you, how the price is drawn and behaves very unpredictably around those levels. Surprisingly, the calculation behind pivot points, and especially to create the first pivot point, isn't that tricky, and it's just the high, low, close divided by 3, and that gives you your baseline in the middle, known as PO, and then around that through, and we don't need to go into the formulas here because that's just for another course, we get other lines created around it, to the upside with R's in front of them and to the downside with S's below them, and these are call them our price magnet levels. Like with the evolution of anything in technical analysis, there is now derivatives of the traditional pivot construction. You have Fibonacci based ones, Woody, Classic, DM, Camarilla. There's lots more, and as you get more experienced you might want to use them. Fibonacci I particularly like, and then followed by Camarilla, but they're, like I say, for another course we're going to just be looking at the traditional setup, which is equally as effective, and we're going to go through a few examples. So here's our first example on the Euro USD 30-minute chart, and it's just a simple chart with the pivots on, and it's just to illustrate the different levels. If we zoom in a bit, we can see our baseline, the P line, and then you can see to the upside R1, R2, R3, R4, R5, and then to the downside S1, 2, 3, 4 and 5 just missing from there at the moment. But you can start to then see how the price behaves around these lines. So our next example, we've got Euro AUD 15-minute chart, and on the left hand side you can see how the price bounces off that S1 line many times, and that could highlight an area of support for the price. You know, if you were short that trade, you might want to get out now or buy in, as you don't think it's going to go any further. So this is, you know, the start of how pivot points can help you out. Now there are many rules for pivot points, and it is an technical analysis art form in itself. We're going to briefly cover off some of them here. So the first one, if the opening price is greater than PO, looking for long trades, and vice versa. So we're first of all trying to put probability on our side, and then trend identification of the longer term is important, and because we'll often see the price fluctuating between R1 and S1, so stronger trend pivot levels broken more easy. So look at those higher time frames before you focusing on the trading window that you're looking at. So for profit targets, you could use the next pivot level, or you could incorporate your stop loss either side of the pivots, or maybe even trail up behind the pivot lines, but never anticipate a breakout or reversal from a pivot point. And as it says there, front running can get you in trouble. Wait for confirmation. Use other tools around the basic pivot point setup. Watch out for news events, especially if you're trading the smaller time frames. They can certainly kill you off very quickly. Nothing's happening. Normally the price ranges between R1 and S1, but if the news is out there, expect to see the highs and the R3s, 4s, S3s, 4s. So be very careful. And on the open, like I say, if the price is greater than S1 or R1, there's a high chance that the price will come back to P0, and at S2, high probability it will head back to S1. The further you go away, so you only know the S3s, S4s of the world, the less likely it's to go greater than that, and you should expect some sort of pullback. So R2 is likely to head back to R1. S2 and R2 are sort of perceived as good collars, good boundaries of the day's activity, and like I say, in strong trends news, the price can go higher than these levels, but more likely not to, and head back to where it was P0 and like mean revert. So here we have the example of a FTSE 100 30-minute chart, and some places on there is very obvious where the price has hit its peak or low of the day and reverses back from those levels. So again, different market, not FX, slightly longer term, still works. So here's just a strategy idea for you, Hikinashi chart, and I've just added on the RSI and Bollinger bands to complement the pivot points. We use those rules to get us in and out, and like I say, very simplified example of what you could potentially do and build up. It's about play around, back test, see what works for you, what markets you trade, different time frames, and like I say, have a go and learn from a bit of experience of just messing around with it. Now, one last example before we move on. We've got the S&P 500 chart. It's set to 1 day, and remember earlier I said you can change these pivots to a longer term horizon, a bit like Fibonacci. Is probably more used in the longer term. You can also use pivot points. Now here we have the pivot points set to weekly. Now the chart's daily, it's Hikinashi chart. Is it relevant? Well, possibly. We can see all these different levels, but it's still a bit messy. So what we can do is click on the pivots, go to the settings, actually change them maybe to a monthly look. Maybe that's more relevant levels that we're looking for, And as you can see, actually we've got some very good examples where the price has just bounced off those pivot points, even at, you know, this sort of price, and it's a not FX market. So this works across all markets, different time frames, and whatever I was to set this back to daily, you'll probably get an error message because obviously it's inside that day, it won't work. And let's just get them back to monthly. Also note here we've got those different types of pivot points I mentioned earlier. There's a Fibonacci one. Again, it's going to give you a slightly different angle, a different one, but again it looks like it works very nicely here. You know, we've got there as well. We're in this range up there and there. So experiment, play around, see what you can come up with. But again, a very useful tool to add into your armory of your trading strategy. So in our first example, we are going to look a bit longer term. We've got Amazon, the huge US stock. It's a daily Hikinashi chart, and that is our foundation. Now, you might have a fundamental view on it, or you may be trading purely technical, but we all pretty much know that it's been a very bullish stock for the last few years, and for obvious reasons. But we want to be more certain about our entries and exits and risk management, so we're just going to use some of those tools we've looked at and apply them on top of our standard Hikinashi chart. So now we've added on our indicators, and what have I put on the chart? Well, we've got the directional moving indicator, slightly modified without the ADX, and as usual, greens above the reds means it's bullish and vice versa. And it's also a trend indicator for us, signifying that Amazon has been bullish for a very long time, but now just turn a bit more bearish. We've got an awesome oscillator to time us into trades. When it goes red, sell. When it goes green, buy. We've got a moving average, 100 moving average, to give us a further trend identifier. Price above, we go long, below we go short, and we can also use that for risk management, stop losses, or other trade strategies of bouncing off the moving average. And also I've put on Bollinger Bands that I've slightly modified, set them to 3 standard deviations rather than the 2. And what I sometimes do with this is use this as a risk management tool, whereas if I want to go long, I will use the lower part as the stop loss area for the long trade, being that, you know, you set it 3 standard deviations. That's over a 99% chance that the price is going to stay within that band. So just to put it the other side of it, it's quite a safe bet. You can play around with that number if you want, 2.33, or even title it back to the 2 that it's set up with, but 2.33 to 3 is a good area. And also the same for the down trade. So we have a potential down trade here, then you could have put the stop there. So we've got all sorts of bases covered here. We've got risk management, entries, exits, timing, just by adding on some of those indicators that we've looked at. In our next example, we've got the GBP, Great British Pound, against the US dollar, a very popular day trading currency pair. We've got the chart, the Hikinashi chart, set to 1 minute, so it's pretty pacey, and as you can see, that only incorporates a small period of time. So what indicators could we apply on top? Let's take a quick look. So here I've added on an RSI. I've sped it up a bit, I've turned it to 7, and I've put a moving average on top of that so we can time our way in off of the RSI. I've also added on a trend line for potential breakouts, and I've also put on pivot points to give us potential targets or areas for stop loss, risk management, trade management. So focusing on the obvious example, I rolled back the chart to the beginning of that day because in FX the there is a good window in the early hours to trade as the market hops up, and we put our trend line on the chart and we're looking for the breakout. We use the RSI crossover with the moving average as potential also timing, so we got a buy signal there. Breaks out, we go into our trade. Where could we put our stop? Well, this is really just a basic example. You could use the other side of the pivot point as an example, so that's a bit of trade risk management we've thrown in there. And also as a potential target, where do we want to get out? Well, maybe we'll keep in the trade until it hits the next pivot point, or we might take a percentage within that range of the next pivot point, or if the trade goes wrong, as you can see it bounced up and then pulls back, we might get out of our trade there, or we might even just trail up behind the pivot point, so maybe into here as a safety net, and we got taken out there. So another example of a sped up FX approach to using the Hikinashi charts. But again, look how smooth that trend is, and compared to a standard bar chart or candlestick chart, it is a lot easier to translate. The first of these approaches is going to be a scalping strategy. Then we're going to have a look at a breakout strategy, followed by a swing strategy. The first of these is the scalping strategy. So what are the components, what are the indicators we're going to use inside this setup? The thing with scalping strategies is that they're very fast moving, so you've got to keep things as simple and clear as possible. That's why we want to use the Hikinashi charts, because it makes the picture more visual for us and makes it more obvious where we want to get in and out from. But we also need indicators that are going to move and quickly and suit this type of trading. So I'm going to use an RSI, which is one of the faster technical analysis indicators. I'm going to put some pivots on there, and to finish off we're going to use trend lines for like our entry sort of, or even exit point. So let's have a look at an example now of how that looks. You may have thought I was going to use FX for a scalping strategy, but here I'm going to use a stock index, and really you can use anything scalping wise as long as the liquidity is good in that market, i.e. there's lots of volume, it's easy to get in and out, there's not much slippage in the price in terms of gaps and that sort of randomness that maybe commodities and maybe some stocks might introduce into the pricing. So we know we get a smooth pricing, and we make that further smooth by using the Hikinashi chart. And here I'm using the FTSE 100. It's a 5-minute Hikinashi chart, and remember that we've got our dojis and spinning tops to look out for as well in terms of the price action. But this is it in its basic form. I've got a fast RSI with a moving average for my timing in. I've got my daily pivot points set up, and I'm going to introduce some trend lines to look for those breaks in the price and the exit, the reverse of the strategy when it hits either a pivot point and reverses back, or it just exhausts itself. Now often you'll find around the opening times of markets you get the volume out of the opening push, and I often like to look at the previous action before. And on our first example we have a trend line that takes in the overnight action, and as you can see it's another obvious example to make things easier, but we do have a breakout around about the open time, and it marries in with the RSI that's already into a buy situation. We don't necessarily have to wait till it turns to the buy, so we could instantly enter as it breaks through. We could have our target as the first pivot, and as you can see it hit it many times, so we've got lots of chances to get out. And if we'd have stayed in, then the price did reverse very quickly and we got the get out here in the RSI. And a further warning was the change from the greens to the reds, so that was really an exit point, and if you'd have stayed in you'd have got back to break even and got nowhere. So with scalping you do have to be really quick, and on top of that very disciplined and decisive. Also remember, with scalping you're not looking to hold for a long time, and often it's almost a statistical type of trade, because what you're looking for are a certain amount of points, a risk return on your points. So you might be happy with 30 points taken from the FTSE because on average you only lose 10 points. So in terms of your portfolio you've got a 3-to-1 win ratio, and this is the art of scalping. It's keeping the win ratio greater than the loss ratio for obvious reasons. You'll also be having to recognise how many wins and losses you have, because there's no point winning 9 out of 10 trades and then losing the 10th one that's bigger than all the other 9. So you might have a high win ratio, but the risk return is also important. So scalping is also a very statistical approach which you need to keep on top of all your results at all time. So our next example is a simple breakout strategy approach. So what are the components to this strategy? Well, actually there aren't many parts to it. We've got the Darvas box, we've got the Bollinger Bands, and we've got the DMI. Right, so in our second example, well, what have we got here? We've got New York Cocoa Futures, throwing in another random asset to show you that it's quite a useful tool, the Hikinashi, in combination with other indicators. And on the bottom I've added a directional movement indicator for a trend filter, and I've set that to 30, so it's a bit longer term. I've got our Darvas box on there, and the settings, if you're interested, is just 5. And I've also got Bollinger Bands here, and I'm using them, and I'll just drill into the settings there, because what I've done is I've left the standard deviations same, but I've quickened the length and I've given it an offset. So I'm using this as my exit tool. So let me just quickly show you an obvious example. So we've got a sell through the Darvas box here. It's still green and red, so we have to wait for that next bar to go red. So we're now in the red. So I will be in that trade until the price comes back into the Bollinger Band. So that's one way of doing it, but I also sometimes trail down, maybe with a moving average behind it, and I take either or as my rule. But again, consistency is very important in this strategy. And then you could have maybe got back in afterwards because we still had a red downtrend, the bars trend was down, it was still below the Darvas box, and you could have followed it in again for another move. And going across again, we've got an obvious one here. Again, we've got green direction, a nice buy flag breaking out, and we get out when it comes back into the Bollinger Band. So it's another way of using Bollinger Bands for trade management, along with the Hikinashi chart, so because we can more easily see the smoother trends from these breakouts. We've got a few more awkward signals. We got some buys here, where the buy here was actually negated with the red trend filter, and same almost again here. It'd be 50-50 that one, but if you lost maybe small loss or break even. And then we've got a break here to the downside. Yes, we've got a red DMI, and we've got multiple signals on the way down, and we come back in here, so a small gain. So again, this is using the Darvas box for a breakout type of system with the Hikinashi chart, and the Hikinashi chart here is showing us the smoother trends and confirming and giving us more confidence that the breakout is actually going to happen and continuing. So it's going to keep you in that trend a lot longer than what you might have been with a bar chart or a candlestick chart. So our final strategy example is a swing trading strategy approach. So what are the components we're going to add on top of the Hikinashi chart for this strategy? Let's take a look. Well, we're going to add moving averages, the awesome oscillator, the DMI, and some trend lines. So for our last strategy example, we've got the US dollar against the Norwegian kroner. It's a 2-hour Hikinashi chart, and we are looking for swing trades. And what do we mean by that? Well, we're looking for a trend direction, so we might be bullish, and then we're looking for pullbacks against that trend, and then we want to enter back in when the trend is changing back in line with the previous longer term trend. So looking at our example here, what have I added onto the chart? Well, I've got two moving averages on there. We've got the 50 and the 100 moving average. I've got a DMI to give me my trend filter, and that's also along with the moving averages, as we'll see in a minute. And then I've got two awesome oscillators for timing purposes as well, and I've actually adjusted those to be either side of the actual 2-hour chart that we're looking at. So we've got a 1-hour faster timing entry awesome oscillator, and then we've got a slower trend filter again, which is actually set to the daily Hikinashi of the US dollar Norwegian kroner, and I'll show you how all that lot works. And the only other bit we haven't got on there yet is a trend line. So let's start looking at some more specific examples within the chart. So I've now added on some trend lines just to illustrate what we're looking at. So this is how I see it. So we've got our two moving averages here, and what I'm looking for is the price to be above to be bullish and below to be bearish. And what I then do is, this is a subjective part of this strategy, is to draw trend lines on the pullbacks, and then what I'm trying to do then is then time it in with the information below from the awesome oscillators and the DMI. So now our first one here, we have a green breakout and it's above the moving average, so all good. And we have a green and a green, very good. But we have a red DMI, so we stay out of that trade. So let's move on to our next obvious example. We have a breakout here, everything's above the moving averages, so that's good. It's pulled back to that, and then we've got green, 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 and we're in. And we can trail up this trend all the way to the top if we want to. We could use maybe the shorter term the awesome oscillator to get out. So we've got a red here, so we might get out here a bit early, but we still made a very good trade. Or we could actually use it again to time our way back in if we've got all greens lining up. And again, we've got another breakout here, pull back here, and are we in? Yeah, actually everything's green. It's only a small trade. We could trail it up and get out. And then we've got this bearish run down to where it breaks in the area. So if I see anything in between these moving averages, I call that no man's land and I stay out. And then I'll wait until it's decisively under the moving averages to look for down trades. So that's a simple swing trading approach, again using Hikinashi to make the trends obvious and help us with our timing of those swings. And it's a 2-hour chart, just showing you that it can work in another market and a different time frame, and that Hikinashi is a very powerful tool when used in combination with other indicators. So one final thought before we end section 4, and we've talked a lot about the good plus points about Hikinashi, and it all looks very good on paper, but when you actually come to use it, actually the biggest problem you're going to face is again yourself and your psychology. And Hikinashi was designed to help improve that. And as we know that Hikinashi now is just an a merging of two standard candlesticks. Now I can guarantee you, if there's any doubt in your discipline and consistency in your trading, what will happen is if there is, say, a big move on any market that you're trading and you're trying to use Hikinashi, but then in the back of your head that, I don't know, you've read some article or you've seen another chart that showing its bounce back up maybe, on a short trade, and from that bounce back you're getting quite itchy whether you should still be in the Hikinashi trade. Is it going to revert all the way back up? Are you going to lose all that profit you've made from that short trade? And what you do is then flip the Hikinashi chart back to the candlestick chart, and then you start trading what you see on the ordinary candlestick chart. And basically you've defeated the whole purpose of using Hikinashi, and you've broken your trading rules. And I can tell you, I've done this before. It is really hard to do, but if you're going to use Hikinashi, you've got to give it a chance to work. You might give back some profits, that's part of the game. Let Hikinashi do its stuff, otherwise there is no point using it. As we've seen, it is a great addition to your trading arsenal, and it's worth sticking with. Give it a go, give it a try. Put it into some of these strategy ideas we've come up with. Come up with your own strategies and approaches. Back test it. Put it into a trading plan and give it some chance. If you don't let it do it properly, then like I say, there's no point in using it. So congratulations and well done. You've completed the course on Hikinashi. Now we've just got a few more final pieces to cover off and then we're done. So let's quickly summarise what we've learnt so far. You should now have a good grasp on how to use Hikinashi, what it is, where it's come from, how you can utilise it in today's modern world of trading, and to give you that edge that you're looking for when you're trading and investing. You can see how effective this sort of chart tool is to give you that edge, and how you can use it across all markets and time frames to create some really effective strategies. And we know how to construct in much detail the Hikinashi chart and what goes into creating such a chart. And you can now more confidently create your own strategies. And also, hopefully, this course has helped you develop a more robust, psychological, disciplined approach to your trading if you are to deploy Hikinashi into your trading world. So now it's time to take these learnings and apply them into the real world of trading. Other resources and support from the Stop Hunter. Again, visit our website. There's a blog, there's articles, other resources, tips, hints, all sorts. You can contact me directly there. But for all support and other inquiries, send me an email, info@thestopHunter.co.uk. So what next for your trading? Well, I suggest you take the next few days off to let it all sink in, digest it, and then come back to it with a fresh mind. But over the next 2 weeks, you need to dive into your trading plan, develop it, finalise it. If you're going to use Hikinashi charts, then work out how you're going to deploy them, your strategies and objectives. Set yourself those SMART goals and objectives. Work out, the realistic side of your trading, what you've got available, how does it fit into your lifestyle. Set those risk and trade management rules, controls and processes, and like you would put down a plan for your bank manager if you're going to try and get a loan from him. Treat your trading like a business, and put down, just write down in paper, on Word document or whatever, your business plan and ideas, your trading business plan, and stick with it, commit to it over the next short period. And moving further out, next month, if you haven't got already your brokers finalised, your trading account sorted out, get that done. Make sure you've got the right computer, software, hardware, internet, your work environment, your workstation as I call it, is all nicely set up so there's no distraction from your trading. And then in terms of the actual software, make sure you've got the charting sorted out, spreadsheet sorted out, and any other resources that you need in your trading. And then further horizons, like I say, commit to your trading plan. Very important to keep track of your results in detail. If you're running a business, you every month do the accounts. It's the same with trading. Do it weekly, monthly. Make sure you're logging your results to see where you're doing well, where you're not doing well, how you can make proper changes to your trading to improve your results. And again, use the resources highlighted to you at the Stop Hunter, and remember, trading is a journey. It's a profession. It's hard at times, and you've got to stick with it and grow with it. So to summarise in taking it further, get as much experience as you can, keep learning, keep that passion and interest in your trading, get a mentor. That always helps. If it's not me, find someone that you like to work with, because it makes your growth a lot easier. Use those resources available to you. Speak and feed off of like-minded traders, other people interested in trading. Remember, it shouldn't be a matter of life and death. So a big thank you to you all for watching and taking part in the course. I hope you enjoyed it and found it useful. I certainly like using Hikinashi and find it a really effective, powerful charting tool for so many reasons. I hope you find it just as useful. Now, if you've liked today's video, please don't forget to give us the thumbs up, and don't forget to hit the subscribe and bell buttons to receive future further notification of content I'm going to produce just like this. I look forward to hearing from you in the comments below how you're getting on with Hikinashi. Let me know any queries, questions, ideas you have in those comments. And all that's left for me to say now is thanks for watching, good luck with the trading, and I'll see you in the next video.